Good afternoon from Toronto. My name is Zohair Hassanbai, your Master of Ceremonies, and Victor Ng is our Technical Director. Welcome, Pun Ying Kok Wai. Welcome to the Canadian Commercial Property Market with a Hong Kong Highlight webinar. Before we start, I want to thank our sponsors. The Toronto office of the Hong Kong Economic and Trade Office, the Hong Kong Trade Development Council in Canada, CBRE, our Royal Bank of Canada, and Invest Hong Kong. We always appreciate your support in so many different ways. A little bit about the Hong Kong Canada Business Association in Toronto. For 36 years, we have been expanding strategic relationships between Canada and Asia using Hong Kong as the platform. We have superb networking events to develop high-level business relationships throughout the year. We are honored to have several distinguished guests who would like to present opening remarks to our audience. I invite Ms. Emily Mo, Director of the Hong Kong Economic and Trade Office in Toronto, to say a few words of welcome. Emily.
Hi, good afternoon, everyone. The world has changed dramatically with the COVID outbreak. In Hong Kong, the government has adopted a suppress and lift strategy to fight the pandemic, with saving lives and limiting economic hardship as the top priority. Through the considered deployment of anti-epidemic and social distancing measures, Hong Kong, you may know, has succeeded in minimizing infections and allowing many economic activities to continue without resorting to a city lockdown. Our government also rolled out relief packages of unprecedented scale to support business, particularly the small and medium-sized companies, and to support employment as a whole. The strategy has largely worked to contain socio-economic fallout. On a positive note, despite these challenges, the commercial real estate market in Hong Kong continues to navigate through turbulent times. Earlier in August this year, the Hong Kong Monetary Authority allowed banks to increase their lending for non-residential property by lifting the loan-to-value ratio to 50% from 40%. With this latest measures, which applies to offices, industrial buildings, and retail premises, activity in Hong Kong's commercial market is likely to gain momentum. And despite the challenges brought by the pandemic and some speculation of the continuation of Hong Kong's rule of law and freedoms, Hong Kong's financial market and investor confidence remain stable. A few days ago, I read a BBC News saying that Hong Kong's status as a key Asian financial hub will remain intact according to business experts. Indeed, the rule of law and freedoms, legitimate rights of our people, are the fundamental core values of Hong Kong and are much cherished by the government and the community. Focusing on the real estate market, the gradual improvement in business momentum in Hong Kong suggests a possible pickup in market activities in the second half of 2020. Not commercial side, but there is also a positive news. For the home sale, we just recorded the biggest weekend of home sales in 14 months in the last weekend of September in Hong Kong. Finally, I would like to thank the Toronto section of Hong Kong CBA for organizing this webinar and arranging such a remarkable panel comprising industry experts and also our head of investment promotion, Mr. Christopher Chan, who will introduce the services offered by Invest Hong Kong for companies that are interested in the real estate investment or other investment in Hong Kong. Hope you will enjoy today's webinar. Thank you.
Thank you, Emily. Thank you for your update on Hong Kong and for your warm greetings. Now, we have a greeting from Ms. Rebecca Pang, the Vice President, Commercial Financial Services for the Diversified Asian Markets. Rebecca.
Good afternoon, colleagues and friends. Thank you very much for having me today. I'm again Rebecca from RBC, covering commercial banking. First of all, I'd like to take the opportunity on behalf of my team at RBC, wishing all of you staying strong and healthy. I also want to thank HKCBA for hosting this session an opportunity for all of us to share ideas and latest perspectives and to stay on top in this ever-evolving environment. Talking about ever-evolving environment, as October is our Small Business Month, I want to recognize, on behalf of RBC and many colleagues, the Canadian SME sectors, as my team and I at RBC have observed firsthand every day for the last 6 months, how nimble, how resilient the Canadian business owners and entrepreneurs have been in adapting to the new environment because of COVID, and in quickly pivoting to preserve liquidity and streamline their operation. I know that their creativity and agility will no doubt serve them very well in the long run. Next, I would also like to quote what John Stackhouse, our Senior Vice President of RBC, as well as the prior Chief Editor of Group and Mail, who recently said that COVID did not crush the future. It merely brought it forward. And it can seem that COVID may change every aspect of our lives, but what we are now experiencing has merely accelerated a decade-long transformation of our economy and our world. The outbreak is creating new economic trends, and there's no going back to business as usual. My colleague, Tommy Lee, is going to speak to some of those details of the key transformation later today. And no doubt, for every activity that is disrupted, there's a corresponding possibility of how space being used and reimagined. And that will point to a longer term trend, as well as outlook of various real estate markets. Without further ado, I'm sure all of you will be sitting tight, getting your pen and paper ready, as we have a great lineup of speakers. With that, I want to pass it back to Sohail. Thank you.
Thank you very much, Rebecca, for your insight and your continued support. Also, I'd like to thank your colleague, Tommy Hui, for managing the RBC component of today's webinar. Sorry, I have a little bit of a sore throat. It's not COVID, don't worry. I would like to briefly introduce Cynthia Wong, our colorful moderator today. She will introduce the knowledgeable panelists. Ms. Cynthia Wong is a broker and Vice President of Investment Properties at CBRE. Over to you, Cynthia.
Thank you, Sohail, and good afternoon, everyone. CBRE is pleased to participate with RBC and Invest Hong Kong in this Canadian commercial property market overview. CBRE is a global real estate company. We are in over 100 countries. We have more than 530 offices globally and over 100,000 employees with 9,250 advisors, brokers, agents, advisors. CBRE ranks at 128 within the Fortune 500 company, and I station in Toronto, Canadian head office. Now I will pass the floor to our CBRE National Research, Thomas Blicklands, to talk about the Canadian landscape.
So I covered Kenya.
Thomas, there is a bit of echo in your line. Can everybody hear clearly?
You want to try again,
Yeah.
Thomas?
Hi, can you guys hear me?
Yes, perfect.
All right, so let's go start going back here. So to start, a bit of a table of contents. First, we're going to quickly go over the CBRE platform. Give me 1 second. I'm told it's still choppy, so let me switch to my computer sound. Give me 1 second.
we did a practice session, but still things can go wrong, can't it? But it's okay. I think he's better. It should be okay now. Oh.
Sir,
Yes.
are you able to hear me?
Perfect.
Okay, perfect. Okay, so let's restart this. Table of contents. So quickly, we're going to give a brief overview of the CBRE platform across the country. We're then going to get into a bit of a high-level overview of the global and Canadian investment markets. We're going to give you a brief overview of the Canadian market drivers. And then I'm going to hand it off to our team in Vancouver for some Vancouver overview, and then our Cynthia back in Toronto for some Toronto-specific trends. So as Cynthia mentioned, we have quite a few professionals across the country. In Canada, we have 23 offices across all 10 provinces. We have over 2,400 employees and 400 plus advisors that spread across the entire nation. So we have a very wide breadth of scope. Similarly, we cover basically all asset classes and sectors of the real estate market. We have professionals who specialize in office, industrial, investment, retail, and land. Multifamily sectors, we also have valuation advisory teams, project management, and workplace strategy professionals. So anything you guys need, we cover that. So now quickly to give you a brief overview of the global and Canadian investment markets. So as I'm sure you're all aware, COVID had an extremely large impact on investment markets across asset classes, not only real estate, but real estate has been affected as well. So what I'm showing here is global investment volumes over the first half of the year. As you can see in Q1, we were actually on pace to outperform previous year's performance in terms of real estate investment activity. We were on pace at 120% of Q1 2019 volumes. Obviously, as global lockdowns started going into effect in March here in the Western Hemisphere, those volumes dropped off and everyone pulled back away from the market. Q2 volumes were about 60% decrease from previous same period last year performance. One more takeaway I want to show here, and something I'm going to kind of come back to throughout my slides, is the importance of Canada and the Americas to the global real estate landscape. So as you see here, the Americas, that's Canada and the United States, account for over 50% of all global investment volume. So there's a significant amount of liquidity here for this type of real estate asset. Now, drilling down into Toronto, or Canada specifically, sorry, we saw a similar trend as the global trend. So over the first quarter of the year, we were also on pace to for near record-setting investment volumes. As you can see, our January total here was almost 50% more, or 100% more than January 2019. Obviously, as lockdowns started going into effect in February and March, those volumes started to pull back, and volumes actually bottomed in May at $1.5 billion. Now, over the last few months, at the end of the summer here, lockdowns have been kind of rolled back, and those volumes are starting to pick up again. So you can see from this slide that in June, volumes ticked back up from their bottom in May. I'm actually collecting volumes for Q3 over the last couple of days, and those volumes have come up significantly over the past 2 to 3 months as well. So there is some buoyancy being seen in the Canadian market as people have kind of familiarized themselves with COVID and become more comfortable operating in this environment. So now I'm going to go over kind of some of the key trends that are driving the market here in Canada. There are 3 things that I'm going to touch on briefly, and I'll show you slides later. But the first thing will be kind of the deal size, or the type of deal that's currently transacting in this environment. The second will be a geographic overview of the Canadian landscape. And the third will be an asset class breakdown, so which sectors have seen the greatest performance so far. So first, in terms of type of transactions, what you'll see in Canada is kind of and I guess globally, is that the deals which get the biggest headlines in the media when it comes to real estate are your trophy assets. So if there's a big office tower that sells or a big land sale that transacts, that's what's going to be caught in the media. But when you really dig into the numbers, the smaller deal size bracket is really the bread and butter of the Canadian landscape. 50% of deals, 50% of deals that get transacted in Canada per year are for below $20 million. So that shows that there's a significant amount of opportunity in those smaller deals. And it's not all just your big trophy assets. And that's important as it relates to COVID, as we'll see on the next slide. One of the transactions or one of the trends we've seen so far over COVID is that the small deals, or that small deal size bracket, has been far more resilient than the larger deal size bracket. So as you can see from the slide, the dark green bars here are the total investment volume for deals below 20 million. You see those bars they've definitely gone down, but they haven't gone away completely, like the light green bars. So light green bars are for deals above 20 million. And so what we've seen is that this smaller deal size bracket, which is typically driven by private investors who have a little bit more flexibility to kind of make investments in higher risk environments like we see today. That section of the market has actually been very resilient and has been still very active over COVID, whereas the larger deals have really dried up a bit as the institutional capital has retreated into a bit of a more cautious kind of holding pattern. In terms of geography, what we see in Canada is that it's pretty much a three-market country. Toronto, Montreal, and Vancouver account for over 70% of investment volume on a yearly basis. Toronto leads the way in that respect, and then Montreal and Vancouver, I apologize, are second and third place. And another interesting takeaway here is, again, we see that breakdown by deal size showing here. So even though Toronto is an extremely developed market, it's extremely dense and urban, a lot of the deals, or 45% of deals, are still done for less than $20 million. Similar thing with Montreal and Vancouver, where that ratio kind of varies between 45 and 65%. So those are the three markets that have really driven investment activity over the last 12 months. From an asset class perspective, what we've seen in Canada over the last 12 months, and especially over COVID, is that industrial and multifamily have seen the greatest levels of activity. Industrial has been supported in Canada by kind of shifting consumer patterns. So e-commerce has been growing a lot here in Canada. Canada trails other Western nations and especially Asia in terms of e-commerce penetration. But that trend is really accelerating over the last 12 months. And that's really driving demand for industrial assets. Similarly, in multifamily, that sector, investment activity for that sector is really being driven by fundamentals. Occupancy for multifamily rental properties in Canada across the major markets is pretty much 100%. There's very low vacancy, and rents have been rising at an increasingly rapid pace. There's quite a bit of demand for rental properties. And that's being kind of borne out in investment interest. Now, in terms of asset classes, again, what we've seen over COVID is that those multifamily and industrial sectors, again, those two strong sectors have been the ones who have been the most resilient. So the percentages here at the top of the chart show what percentage of pre-COVID investment volumes have been maintained so far since lockdown started going into effect in March and April. So what you can see on the left chart there is that the land, industrial, and multifamily sectors, and to a lesser extent retail, have been quite resilient. If you look on the chart to the right, that's just for transactions below 20 million. You'll see again, extremely resilient for that deal size bracket. Again, industrial, multifamily, and ICI, all between 63 and 78% of pre-COVID investment levels. So those are trends that will be spoken to a little bit greater detail by Cynthia and Robert when they get into kind of their market specific discussions. But that's really what we're seeing at the national level here in Canada. So now we're going to I'm going to hand it off to Victor to do a brief or Cynthia to do an introduction of the presenter for Vancouver.
Cynthia, please
unmute. Thank you, Thomas. Now we pass it over to our Vancouver team, and Robert will be speaking, and David Ho, our team lead, he apologized. He has a showing that he has to attend and cannot reschedule. So now pass it to Robert.
Thank you, Cynthia. Can everyone hear me?
Yes.
Perfect. Well, yeah, thanks everyone for coming on the call. Pleasure to be here. So just to briefly introduce myself and perhaps David and the team. We run the international markets team out of Vancouver, and we deal with all types of investment across all asset classes. But kind of what I want to do for you today is just to give a brief, like on the ground touch points as to what's happening in Vancouver. and particularly as Thomas commented on, like on 3 asset classes that we are seeing the most activity in, I guess, during these COVID months between March and October. So moving on to the first slide, and just as a forewarning, apologies if I'm quite brief on this. Just trying to fit this within the time allotted. So one of the main asset classes that we've seen a lot of interest, a lot of buying and selling activity, and which has kept me and the team busy for honestly the past 6 months, like too busy, is multifamily. And multifamily, for those who aren't familiar with it, is apartments. So multi-unit apartments, whether they're en bloc, or stratified, in the city of Vancouver. And in the past 6 months, since COVID started in March, we've seen almost 500 million in transactions, and the cap rate and the pricing remains to be very stable even through COVID. With caps ranging between 2% and 4%, and price per doors of on average about $300,000, with highs of $700,000 transacted in these past few months. And the question is why? Why is there continued investment activity in this asset classes? I'd say there's 3 main drivers. One is that rents continue to be collected. We did a profile of all the multifamily owners in Vancouver survey, and 95% of them continue to collect rent 100%. 2, everyone needs a place to live. I mean, it's pretty real estate 101. And I think 3rd is that the availability of financing for multifamily real estate is at all-time lows. To get a CMHC mortgage for a multifamily building, depending on who you are or what kind of term you're looking at, we've had clients tell us that they're receiving between 1.1% and 1.7 to 1.8% mortgage financing. So given the lowering of the financing, the cost of capital, we're just seeing more and more interest in this asset class. Next slide, please. The second is industrial. And I like Vancouver. I mean, Cynthia and Thomas have spoken and will speak more about kind of the drivers in terms of e-commerce sales growth and such. But what's interesting about Vancouver is that the industrial supply in Vancouver is limited and shrinking at the same time. Their uses. So first off, you have a shrinking supply of industrial land. And second off, we have a lot of growth as well. So what we're seeing now is in Vancouver, what you've seen in Hong Kong for the past few decades is that we're seeing the first developments of multi-level industrial logistics centers. And the image we have below there is by Oxford. It's a multi-level industrial development that they're building right now with anticipated completion in 2022. Next slide, please. Hello, next slide, please. Thank you. And kind of the last major asset type that we've seen a phenomenal amount of activity in the past few months is land. And that includes residential land, so land that's being developed for condos and rental apartments, as well as industrial land, commercial land. So land that's for office development, industrial development, and whatnot. And I think some of the key drivers here is why is the demand remaining consistent? Is I think it's the continued idea that Vancouver will continue to grow, for the foreseeable future. And a lot of the focus is on what I would say mixed use, multi-purpose master plan development communities in which there's a broad range of residential, commercial, retail, office, and even some like warehousing, all in one large development, as well as developments that are on existing transit lines. One of the biggest land transactions actually happened in August of this year. Concord Pacific bought the St. Paul's Hospital site in downtown Vancouver for a record $1 billion, which represented $600 a square foot buildable, which still remains to be a landmark pricing transaction to the state. And yes, thank you.
Thank you, Robert. And also just a reminder to the audience that please ask questions. We certainly cover a lot of the topics, and this is a taped and recorded session. So Sohair will make this available, and our slides will forward to HKCBA to be distributed, because I don't expect all the audience to be able to memorize all the data points. Thank you.
Cynthia, did you want to go through your slides now?
Yeah, okay. So thank you for a very good summary for the Vancouver market. Echoing the Vancouver market, Toronto industrial, multifamily, and also development land has been resilient and performing very well. Let's touch on some interesting sectors. The retail. Retail is definitely going through transformation, challenges, or some even call crisis. But however, in Chinese saying, whenever there is a crisis, there will be opportunity. This is a slide that if audience and various bankers and CBRE clients have actually seen, is the retail, one slide go back, is the retail entrance from the Asian retailers. And some of these international retailers from Asia has been very successful prior to coming over to Canada. And however, while we were before COVID, our retail has been booming and doing very successful. Some of these, for example, international known bubble tea companies or other retailers mentioned that they actually have to wait for a retail space for 2 to 3 years before they can open shop. So now with malls and buying habits changing to e-commerce, would these retailers be able to get their store open in, let's say, 6 months' time or 9 months' time? And let's move forward to some of the success stories, including Walmart. They have increased the total revenue since Q2, 5.6%. Net sales has also gone up 5.7% and profit over 80%. Second one is Lululemon. Lululemon, I guess, also with health conscious fitness, and now everybody can work from home. This is just the background for my front garden so that we can cheer everybody up. So they actually have originally the loyal customer base, and they are very successful connecting through social media and different lifestyle. They can have a business tie top and a yoga pants, and a strong brand value. And also for Lululemon, there is the next slides for the 3 key point: market expansion, product innovation, and the omni-channel, both in the e-commerce and lining up in Eaton Center, Yorkdale, even in Ottawa on the Lululemon in the shopping malls. And the next very interesting sector is our groceries and the PPE, the rice, has pasta and canned soup, they all increase triple digit on percentage. Definitely panic buying on toilet paper and paper towels. However, behind these scenes, does increase in performance, revenue equate directly to the bottom line? Yes and no, because some of the cost has gone up on cleaning, disinfecting, and some of the labor has gone up, and also on quarantine. So we can look at it detailedly in our discussion points. And now we move to the industrial. The takeaway from the following 3 slides is it was in a very healthy market since 2010, and with rents growing steadily. But if you notice from 2017, 18, 19 onwards, there is a big jump and in the rents. Now for GTA, we call it Greater Toronto Area. Now we actually call it GTHA, Greater Toronto Hamilton Area. We surpassed double digit, $12, $13 per square foot, triple net rent per year. And that also increased, equate to the upward trends in the sale price per square foot on buildings. And the next slides that also increase in the land cost for the industrial. As I said, these slides can be made available. Please reach out to HKCBA. And now we thank everybody for listening to the CBRE presentation. And we are going to introduce our next speaker. Is from RBC. Tommy Lee is from the Commercial Lending Division and the Investment Commercial Real Estate Branch. Take it away, Tommy.
Okay, thank you, Cynthia. Okay, well, first of all, thank you very much, HKCBA and CBRE for your invitation to participate in this webinar. Since there are some overseas participants in this webinar, let me begin by giving you a little background about RBC. Well, RBC is Canada's largest bank by assets. Like the market capitalization is $150 billion and is Canada's most valued brand. We have 12 million clients, including Canada's most affluent individuals, and we are market share leader across multiple product categories. In a world scale, we are the 12th largest bank in the world. We have 60 million clients worldwide, 77,000 dedicated employees, and one of the biggest credit rating among global banks. Well, we also operate quite actively in US and Caribbean. Well, we have two US banks like City National Bank and RBC Bank. In US, we are the 7th largest wealth manager. And in Caribbean, we operate in 17 countries and territories with 12,000 employees in the US. Well, in terms of lending and wealth management, we are, of course, like on the front line. We are on the top as well. Well, it has been more than half a year since the COVID-19 pandemic started making significant changes to our lives in Canada. It seems that it may change everything: how we work, how we shop, entertain, share information, travel, heal, learn, and trade. A lot of these changes will affect our use and demand for different types of commercial properties. It is worth mentioning that we are now experiencing, well, has merely accelerated a decade-long transformation of our economy. On top of that, the outbreak is creating new economic trends. There's no going back to business as usual. Now, let's explore into 5 of the 8 identified areas on the slide in more details. How we work. The pandemic, of course, has given us a lot of changes, the first thing being how we work. What we are seeing is nearly 5 million more Canadians, that is almost about 40% of our workforce, are working from home now. Work from homers are likely to be highly educated and concentrated in finance, real estate, professional services, management, wholesale, and IT. And 75% of Canadians would prefer to work from home a little bit or a lot more often once restrictions ease. 57% of Canadians are unwilling to go to a business conference until there is a vaccine. So what does all these observations mean? It means employers and office landlords will need to invest heavily in workplace PPE and office reconfigurations down the road. And there will be less need and demand for office space. What we are seeing down is that co-working office spaces will be probably needed less, and conference centers will be affected as well. How we shop. What we are seeing here is nearly 3 in 10 Canadians are now shopping online for things they normally would have bought in a store. 70% of Americans expect to avoid some public spaces after the lockdown ease. And more than half say that they expect to stay away from shopping malls. The meaning behind it is traditional brick and mortar business models, including malls, will be challenged while social distancing measures are in place. And digitally enabled retailers can capture more customers outside their home base. What we are seeing up is businesses pivoting online services such as online orders for delivery and pickup, and demand for industrial properties from where business can operate with a web presence and storage space. And what we are seeing down are department stores, secondary and tertiary malls, high density commercial properties. How we watch or how we entertain. There will be less money on books and public entertainment and more on home entertainment, as can be evidenced by the fact that the users of Amazon video live streaming platform Twitch streamed 50% more hours between March and April, and now is up to 1.6 billion hours per month. The other one, Netflix, added 16 million subscribers in just Q1. And then there will be collapse of live events has led to a surge in virtual competitions. Esport audience, which is estimated to be 500 million people in 2020, there will be a lot more down the road. 43% of Canadians won't go to an arena, stadium, or concert venue until there is a vaccine. And cinemas as an industry, as we can see it, is undergoing consolidation. In-person arts and culture purveyors saw a spike in online traffic. 2 examples. British Museum went from 2,000 daily online visits to 75,000. And in Canada, Vancouver Symphony Orchestra received more than 120,000 views for recent virtual performances. So here, what we are seeing is down are the needs for the cinemas and sports arenas, museums, and art galleries. How we share, there will be more bandwidth, more data, and more hacks. And what we can see or derive from here is that a lot of our buildings will need to be upgraded with higher bandwidth, and especially in those areas like where we work and entertain. How we travel. What we are seeing here is 68% of Canadians are unlikely to take a vacation in 2020. Canadians say they are significantly less likely to travel to other provinces due to the COVID. And once the pandemic has ended, 63% prefer to drive than fly, and 62% prefer to stay in Canada. Only 32% are willing to stay in a hotel or resort, and 10% only to take a cruise. So what that means is there will be slow and thinly distributed recovery to tourism, with more role-based vacations to smaller centers. And then there will be decline of festivals, events, and major attractions, and more desire for localized adventures and experiences. So we see there will be less need for large hotels, resorts, and cruise liners. How we heal. since this doesn't really affect the use of commercial properties directly, I think it's more to do with technological upgrading for a lot of our medical facilities. I'm not going deep into it. How we learn. This is another area where we are impacted by quite a bit. In March, 1.4 million Canadian university students shifted to online learning, and many universities now moving to a blended model for the full term. Now, Canada's largest online-only school, Athabasca University, saw April enrollment grow by 12.3% for undergraduates and by 10.7% for graduate studies. What that means is universities and colleges will spend more on technological infrastructure. Traditional course design and pedagogy will turn to alternate delivery methods as past resistance to online learning fades. What we are seeing down are physical premises for schools, universities, and international student enrollment. How we trade. There will be more protectionism, fewer imports, and then there will be higher prices. While the impact on the use of commercial space will be quite diverse, and we're not going to take too much into it for this presentation. So summarizing what we have said above, like we see that the new normal is evolving and demand for different types of properties will change. For industrial, like a lot of the CBRE experts here have pointed out, the demand is on the rise. For retail, we have online shopping challenges on shopping malls and retail outlets. Look at the Amazon example. While supermarkets and pharmacies hold very strong because they represent the basic necessities. Restaurants probably need drive-thrus and take-out facilities to better equip themselves. Offices, like we have home office challenge. The effect is probably going to be gradual and a little bit more long-term, but we see the trend. Multi-residential, pretty much business as usual, as pointed out by Robert, our Vancouver expert, and also I think also the other presenters as well. Special use properties, we can see that cinemas, arenas, home entertainment challenges like Netflix will be eating away a lot of them. Schools, universities, online classes, like we see that, okay, schools and universities, they are challenged by online classes. And then we can see that actually even our Toronto school boards are also allowing more and more people to take online classes because the outbreak of COVID cases in the schools are developing. Hotel resorts, like we see travel restrictions are putting a lot of pressure on them. The need will be different in the future. So with that, I conclude the presentation from RBC, and I want to just thank you for your attention. Passing back to Cynthia, please.
Thank you, Tommy, for an insightful presentation from RBC. And now we have Christopher Chan, Head of Invest Hong Kong and stationed in Canada, to go through opportunities for Canadian companies in Hong Kong.
Everyone,
now to you, Chris.
Hello, everyone. Thank you for taking part. Let me get my presentation up. Allow me to introduce myself. My name is Christopher Chen. I'm head of the Invest HK presence here for Canada. Invest HK, in the event that you didn't know, is an agency of the HKSAR government responsible for foreign direct investment in the commercial interests of the Hong Kong government. The presentation I'll be giving is going to be a little bit different from what you've seen from CBRE and RBC. It's going to present Hong Kong as a destination of investment. Also, as this is a webinar put together by HKCBA, I suppose we're representing the HK part of the acronym. Some of this will be a backgrounder to the Hong Kong marketplace. but it will also highlight the opportunities of Hong Kong going into the 21st century. A little bit of mention for the property market. It's been no secret that 2020 has been a rough year. The combination of the protest movement, COVID-19, imposition of the national security law and its feedback, a resurgence of COVID-19, a resurgence of the protest movement has basically led to an average drop in commercial rental property rates of about 25%, which is extremely severe for Hong Kong. Luxury retail has been hit the worst with an average drop of about 30%. But in that darkness, there are opportunities, and I'm hoping to shed light on some of the opportunities. My presentation is only 10 minutes long, so obviously I'm not going to be able to touch on all of them, but I would like to be able to shed some light on what are some of the economic opportunities for certain sectors of the Canadian economy. For those of you who don't know, Hong Kong is one of the world's top capital market. It is one of the great investment centers of the world. It is ranked more or less around number 3 in the world after New York and London. Is the second world's best financial system. It is the number 1 financial hub of Asia. No matter how much it gets battered, even if it drops one, Hong Kong will always come back and maintain that position. It's the easiest place in Asia to do business. It takes about 1.5 days to start a business in Hong Kong, no exceptions. And even if your business requires a regulated license, that still applies, even though the license will take a few more days than that. It is one of the world's best tax regimes. Lowest tax jurisdiction going anywhere from 12% to 16%, to depend upon the type of industry, as well as exemptions that you would be eligible for. It is a country that is ruled by law. The basic law, the common law, which is based on the Commonwealth law, is applicable in Hong Kong, and Hong Kong provides trade dispute resolution unlike any other country in Asia. Many companies establish a foothold, establish a company in Hong Kong to operate in other jurisdictions. If in the event they fall into a trade dispute, such as a breach of agreement or breach of contract in another jurisdiction, these companies have the luxury of going back to Hong Kong, going into court, winning the case, and having that case, having the ruling observed by the other jurisdictions. One thing that many companies, entities here in Canada may not know is that Hong Kong is now considered part of a larger economic super region called the Greater Bay Area. Not to be confused with the Greater Bay Area of San Francisco. The Greater Bay Area of Hong Kong and the Pearl River Delta is basically Hong Kong in the cities lining the Pearl River Delta, i.e. the province of Guangdong. That includes Shenzhen and Guangzhou cities. That has a population of about 71 million people, which is a lot of people by any standard. And in terms of GDP, creates $1.8 trillion. As an economic super region, this would be comparable to, say, Silicon Valley in the United States, the Ruhr Valley of Germany, the corridor from New York, Boston, Philadelphia, or Toronto, Montreal, Windsor, Hamilton. The GBA contributes to the strong wealth growth momentum in Greater China. It has the world's largest concentration of high net worth individuals in China, and these high net worth families are what's fueling the equities and capital markets of Asia predominantly. Most people, when they think about what Hong Kong is a financial center, and that's certainly true. And that was true starting from the 60s and hitting heights in the 70s, 80s, and 90s and 2000s. It is the leading capital market, largest offshore renminbi business hub. 70% of renminbi that goes from China to the outside world is funneled through Hong Kong. That is a significant number, and it actually means that there is an immense amount of Chinese asset management and private equity specialization found in one city that is not found anywhere else in the world. It is a premier banking center, it is a premier asset management center, it's an insurance market. It is only competing against New York and London in the regard in the concentration of capital and capital specialization. However, Hong Kong cannot survive in the 21st century through financial markets alone. The government realizes that, the society realizes that, the people realize that. So through leveraging the financial services market, Hong Kong's government is endeavoring to create an environment of new opportunities by opening up new sectors of industry. It starts with priming the pot by the government. The government has set aside what's called the Innovation Technology Fund. This is effectively a US $13 billion public pot, public venture capital pot geared towards certain industries within innovation technology, new media, fintech, startups, anything to do with innovation technology effectively, that is given out by specific agencies of the Hong Kong government. For example, the Start Me Up division of InvestHK, which is a practice group specifically geared towards startups, the Hong Kong Monetary Authority, the Securities and Financial Commission, the Insurance Authority. We all are agents of fund disbursement of this Innovation and Technology Fund. This is the public pot. As you can see, it has led to a significant amount of startups, an increase of 200% of startups over 6 years. I'm not going to go through each and every single subcategory of what those startups are. Needless to say, they're all in innovation and technology. Again, there's been a 200% increase of startups over the last 6 years. And there's been a 424% increase in the employees of these startups over the last 6 years. And that's important to us because here in InvestHK, as a government agency, our job is to spur the economy. And a key indicator of spurring the economy is actually finding people work. And so helping new companies, either as a startup or as an established company, and I cite RBC as a company that's fairly well established and who InvestHK helped with expansion plans. It is meaningful to see the expansion of Canadian companies in Hong Kong. Once a company is in Hong Kong, you're primed for growth. I'd like to cite that the number of unicorns in the Greater Bay Area, and a unicorn refers to any startup with at least $1 billion USD valuation, has grown to 28 unicorns in the GBA. And the reason for that is the chart on the right. If you remember, I stated that about 70% of all renminbi from the People's Republic gets funneled into Hong Kong. And that has led to, there's a lot of renminbi in Hong Kong, but there's a lot of investment specialists in Hong Kong managing that renminbi, looking for investment opportunities outside of normal investment or regular investment opportunities such as the stock market or property. A little bit more about funding sources, and I cite this as this slide is pretty much geared towards fintech companies, but I don't want it to just focus on fintech. I mean, this applies to almost all companies within the innovation technology sectors. Through the life cycle funnel of a company, from just the initial setup all the way to overseas expansion, the Hong Kong government provides funding and mentorship every step of the way. From the company setup, waiver of business registration fee, to tax exemption for the first year. Through if your entity is conducting R&D, there are a number of subsidies and grants that the Hong Kong government is prepared to give. In terms of hiring, we will subsidize the first number of hires, particularly if they are hired directly from university. Business development and fundraising have their own subsidies. Fundraising has a very interesting one. If a company has attracted funding from one of 25 world-renowned venture capital companies, such as Sequoia Capital, the Hong Kong government will match that amount as par for the course. The last one at the bottom for overseas expansion is an interesting one. If you are established in Hong Kong and you wish to expand into the other parts of Asia, namely Southeast Asia, South Asia, and North Asia, inclusive of mainland China, there is a subsidy. This reinforces Hong Kong's role as a hub for companies to enter the rest of Asia as the best port of entry, for that matter. So the previous slides were all about government subsidies. I'd like to talk a little bit about private capital. I just cite fintech investments. Over the last 5 years, there's been about, actually this is a little bit out of date, there's been about $2 billion worth of private venture capital investments in fintech. For innovation technology, that number has actually gone to about $12 billion in terms of private equity. Then that's the figure on the left. The figure on the right, in terms of IPO fundraising, Hong Kong stock market is the world's #1 for stock market fundraising. There is no question about it. It has been #1 for the last 3 years in the running and will continue to stay so. And that is mostly because of secondary listings through mainland Chinese and global multinationals who may already have a listing on the New York Stock Exchange or the LSE, but wish to have a secondary listing in Hong Kong. After the Alibaba secondary listing of November 2019, that pace has increased exponentially. We like to think that companies simply were inspired by the Alibaba secondary listing and thought, well, we can do that too. So that's all well and good. So who is InvestHK? We like to say InvestHK connects the dots. We plug you into our ecosystem. For any Canadian entity, we like to connect you with all facets of the Hong Kong economy. In terms of getting a company into Hong Kong, putting it bluntly, a lot of companies offer that. That is not what makes us special. In terms of company registration, getting you set up with a lawyer or accountant or even a commercial real estate company, what we do, what our value add is what we're proud of. And that value add is to introduce you to potential business partners, clients, a business network to make you fly. Getting into Hong Kong is super easy. Like I said, it takes 1.5 days. Doing well in a competitive market like Hong Kong takes some work. And we like to arm companies as much as possible by introducing the potential investors, corporates like banks, insurance companies, associations, multipliers like incubators or accelerators, universities for hiring, the other entities of Hong Kong Incorporated, that would be like the Productivity Council, Severnport Science Park, ASTRI, which is Applied Science Research Institute, the other entities within the Hong Kong government, such as immigration or revenue, regulators, as well as we will always introduce Canadian companies to the Canadian Trade Commission. Why get into a country with only one country support when you can get into a country with two? So, like you say, we like to connect the dots and plug you into our ecosystem. The last slide is our track record. There are approximately 200 Canadian companies in Hong Kong. We put 180 of them there. We have worked on everyone from startups all the way to companies as large as RBC. We've worked with companies such as Manulife Bank, the Quebec government, CPPIB, Lululemon, Intact, Ontario Teachers, Macmillan, Universities of Western Ontario, Waterloo, University of British Columbia. Basically, anytime a company wishes to enter Asia Pacific through a port of entry like Hong Kong, we're there to help them from initial setup all the way to expansion of new divisions. So with that, I'd like to return the mic back to Cynthia.
Thank you, Christopher. And that's an impressive Canadian Invest Hong Kong client list, and also the detailed scope and opportunities of Hong Kong. To keep our session on time, we might have 1 minute to couple of the discussion topics. And let me start with the question to Christopher. If I was a company going to Hong Kong, what would be the expectation in terms of government support? Please, if we can have 60 seconds of your intel.
Okay, sure. Quick answer, you would be grandfathered, nurtured by InvestHK, directed to a practice group that specializes. Let's say it's retail. We pair you up with the retail group, and the retail group would set you up with company registration, accounting, legal, corporate secretary, corporate leasing, private leasing, but then also introduce you to property developers, trade associations, retail associations, lenders, project financing, and basically whatever type of company you request, we'll do our best to put you in front of. It's basically, we open the doors for you. You don't have to knock on any doors.
So I encourage audience and also participants to reach out to Christopher, and I'm sure your slides and contact information can be obtained by from HKCBA. And then the second part of this question, which you touch on the technology and hub, is there other particular industry that are getting special attentions?
Yes, particularly for Canadian companies. We don't make any secret of it. We actually place strategic priority towards companies such as fintech, life science, advanced manufacturing, artificial intelligence, companies that fall within innovation and technology. We also, Hong Kong being what it is, we also do have a soft spot for financial service companies, like family offices or asset managers. These are companies that would see the full benefit of Hong Kong's history of being a financial capital and basically an investment center.
Thank you. And I know that I noticed that some of the panelists and speakers are answering some of the Q&A question. We have an excellent question from Sonia, but before we get to that one, for Tommy Lee, how will RBC advise your customers and clients on what type of commercial properties to invest in?
Typically, RBCs, like all the frontline people, are now trained as strategic advisors. What we will be telling our clients is that the reality has changed, and then the need and demand for different types of commercial space is also changing and evolving. Of course, I think investors typically will look for returns and stability of their return and all these things, right? Which is like totally in line with the bank's general approach. What we are going to do is like we are going to work with clients, and we start very early in their, investment strategy to participate in whatever they are looking at and give them opinion. I think typically we will be also pulling the research results and expert advice from parties like CBRE and our appraisers, and also like other big firms, like because they all publish very useful information for our use. And we will typically pass all these information to our customers, like to help them with their final decision in the process.
And thank you for trusting CBRE as your trusted advisors, and thank you for audience and HKCBA for considering CBRE. Then the second portion, how do you see the future trend in commercial mortgage interest rate?
This, I think, as pointed out by Robert in Vancouver, financing for the time being is very, very cheap, especially for multi-res CMHC guaranteed deals. I think they are like never heard of, and I've never seen them in my 30 years of career as a commercial banker. Of course, I think moving forward, I think the interest rate will be kept low for a while. I think we're talking about 2-3 years. while that translates into a low cost of fund for banks, like when we look at financing a piece of commercial real estate, of course, there are other considerations like the risk of the class of property that we're looking at, and our exposure, how much are we asked to finance? Like if you max it out, or if you're just asking for just a portion of financing, will ultimately affect the risk involved. And we typically compensate the bank's risk by a spread. So the spread will depend on the type of deal and transaction we're looking at, but the cost of fund will definitely remain low for the next while.
Thank you, Tommy. And since Sonia has an excellent question, maybe I'll just read the question and Tommy respond with a terrific answer as well. The picture you have presented is downright scary. Despite purchases via Amazon and switching of entertainment to, say, Netflix, is overall consumption expected to drop? How to salvage? Tommy.
Yeah. Okay. I actually sent Sonia the my response already, but I think she has very good questions. But I think the ultimate level of consumption with regard to entertainment, switching to home entertainment like Netflix, or retail like shifting in demand will definitely drive changes in the use of commercial space and properties. And of course, the longer term effect, I think we are still in the middle of it. We do not have the crystal ball and we don't know how things will end up being. But one thing I believe definitely is going to happen is that the future reality of demand and supply will definitely drive to another balance, like where if you don't have enough demand for certain things, price will come down, supply will get less, and then we come to a balance. I think that's the natural economic way of market adjustment, probably. Yeah.
Thank you. And also to make the CBRE presentation with all the data, we have to thank CBRE National Research, Thomas and the teams across Canada, and also Shekhar also participate today on all the hard work and the data. And since each of the city, each of the region, our deck is over 400 to 500 slides per topic. We encourage audience and clients to opt in from our CBRE website, which we will, because of privacy law in Canada and North America, we cannot send information to you, but if you opt in from our website, you will get all the release data on a weekly basis or monthly basis, and also for the all the studies that we release. And in addition to what Royal Bank and Tommy mentioned about the multifamily and the hotel, I noticed that in China and some of the other countries, hotel, as much as yes, we are going through a turbulent and challenging times, there is a lot of local supports and staycation and travel, explore Canada. So we encourage, instead of work from home, I literally work from Ottawa Hotel. WFH is actually a hotel and other hotels because they needed our support. And now I'm going to pass the mic back to Sohair.
Thank you very much, Cynthia. What a wonderful panel and great information. You know, when I'm listening to you, the time really goes by quickly. We have so much information to absorb. And I'd like to echo what Cynthia said earlier. We are recording this session. So if you contact us, and I'll give you the email a little bit later, you can review it at your own leisure. Similarly to how Cynthia had thanked the team, I would like to thank them now, the panelists. Cynthia, of course, for being the moderator and a panelist. Thank you very much. And of course, the other panelists, Thomas and Robert, Thomas Biglands and Robert Rearman from CBRE, Tommy Lee from RBC, and Chris Chen from Invest Hong Kong. We want to thank the greeters, Ms. Emily Mo and Ms. Rebecca Pang, our sponsors, of course, the Hong Kong Economic and Trade Office in Toronto, the Hong Kong Trade Development Council in Canada, CBRE, Royal Bank of Canada, and Invest Hong Kong. We are grateful for attendees, for all of you who have stayed from the beginning to the end, who took the time to join us. Our friends in Hong Kong, I want to thank them, in Hong Kong and Canada, we want to thank them, plus, of course, our Hong Kong family supporters. I want to make a special thanks to Cynthia. She really multitasked on this project, on this webinar, of course, as the moderator and panelist. She's also a board member of the Hong Kong Canada Business Association in Toronto. She's really instrumental in putting all this together, the panelists together, which of course is a major part of the webinar. And of course, the theme of today's webinar. She worked hard, she put all the things together, and I want to make sure that we show our appreciation to her. Thank you very much.
And also, thank you, and also teamwork, because on all the excellent presentation materials from all the panels, and I actually have to do a shout out. I actually getting some WhatsApp and text messages from Hong Kong and Asia Pacific. Thanks for staying up. It's 2 a.m. in the morning or 3 in Japan. And thank you so much.
Excellent. Okay. So now, if you have any additional questions that come up, you do please send them to me. The email address is now being shown. And also, if you have, and I will direct it to the appropriate panelists, and they will get back to you. Your requests for a webinar video, also you can direct it to this email address. Our next webinar is on November 17th. I mentioned a little bit earlier to our panelists. The general topic is Canada and Hong Kong benefiting from international tax regimes. We have even more webinars planned. Let us know if you want your colleagues, or you or your colleagues want to be on our mailing list, and also, or maybe to be our sponsor. Many thanks to our speakers. They are the backbone of this webinar. We appreciate your perspectives as the sector prevails in in our current challenging time. Also, many thanks to our attendees who stayed from the beginning to the end. We really appreciate that. And you for taking the time to watch and to be informed. Thank you again. Enjoy the rest of the day.